Hello everyone, welcome back to Bitcoin Dorks, your go-to source for daily updates on the cryptocurrency market and important news. Today, we'll be discussing the recent price movements of Bitcoin and its potential impact on the market. As you may already know, Bitcoin has been hovering around the $60,000 price level for the past few weeks. However, in recent days, the price has taken a sharp downturn, currently trading at around $55,000 at the time of this video. This has raised concerns among investors and traders alike. Some experts believe that the recent price drop is due to a variety of factors, including a decline in trading volumes and a general sense of market uncertainty. However, one key driver of the price drop may be the upcoming release of US CPI, Consumer Price Index, data and the FOMC, Federal Open Market Committee, minutes. The US CPI measures the change in prices of goods and services purchased by consumers. This data is closely monitored by investors as it provides insight into the state of the economy and inflation rates. If the CPI data shows a higher than expected increase in prices, it could potentially lead to higher inflation rates and interest rate hikes, which could negatively impact the cryptocurrency market. Furthermore, the FOMC minutes are closely watched by investors as they provide insights into the Federal Reserve's monetary policy decisions. If the FOMC minutes suggest a shift towards a more hawkish stance on interest rates, it could lead to further market uncertainty and potentially push the price of Bitcoin down even further. The Consumer Price Index, or CPI, is a measure of the average change over time in the prices paid by urban consumers for a market basket of consumer goods and services. This data is released monthly by the U.S. Bureau of Labor Statistics, and it is closely watched by investors and traders as it provides insight into the state of the economy and inflation rates. If the CPI data shows a higher than expected increase in prices, it could potentially lead to higher inflation rates and interest rate hikes, which could negatively impact the cryptocurrency market. This is because cryptocurrency markets are heavily influenced by macroeconomic factors, such as inflation rates and interest rates. When inflation rates rise, investors tend to shift their money towards assets that can protect their purchasing power, such as gold and other commodities. This can lead to a decrease in demand for cryptocurrencies, which could push their prices down. On the other hand, if the CPI data shows a lower than expected increase in prices, it could potentially lead to lower inflation rates and a more accommodative monetary policy, which could benefit the cryptocurrency market. This is because lower inflation rates and interest rates tend to make alternative investments more attractive, as they offer higher returns in a low interest rate environment. The Federal Open Market Committee, or FOMC, is the branch of the Federal Reserve responsible for setting monetary policy. The FOMC meets 8 times per year to discuss economic and financial conditions and to set the target federal funds rate, which is the interest rate at which depository institutions lend reserve balances to other depository institutions overnight. The FOMC minutes provide insights into the Federal Reserve's monetary policy decisions, and they are closely watched by investors and traders as they can have a significant impact on financial markets. If the FOMC minutes suggest a shift towards a more hawkish stance on interest rates, it could lead to further market uncertainty and potentially push the price of Bitcoin down even further. On the other hand, if the FOMC minutes suggest a more accommodative stance on interest rates, it could lead to increased demand for cryptocurrencies as investors seek out higher returns in a low interest rate environment. It's also worth noting that the impact of these events on the cryptocurrency market is not always straightforward. Cryptocurrencies are a relatively new asset class, and their relationship with macroeconomic factors is still being explored. For example, some analysts believe that cryptocurrencies could serve as a hedge against inflation, as they are not tied to traditional financial institutions or government-backed currencies. This means that they may be less susceptible to inflationary pressures. Furthermore, some investors may see cryptocurrencies as a safe haven asset similar to gold in times of market uncertainty. This could lead to increased demand for cryptocurrencies in the event of a market downturn, regardless of macroeconomic factors. In conclusion, the upcoming release of US CPI data and FOMC minutes are key events that investors will be closely watching. While there are a variety of factors that could be contributing to the recent decline in the price of Bitcoin, these macroeconomic events could play a significant role in the direction of the market. As always, we recommend that you keep a close eye on the market and make informed decisions based on your own risk tolerance and investment goals. Thank you for tuning in to Bitcoin